Assalamualaikum and good afternoon, everyone. So today is gonna be our final meeting, okay, with our final topic number 11, yeah, the cost of capital. Okay, let me share with you the screen. Okay, hang on, Okay. Okay, so basically this topic is actually going to discuss about long-term financing. Okay, remember one part we have short-term financing, whereby if we have shortages in terms of our current assets, for example, we can borrow short-term basis. Okay, here topic number 11, the cost of capital, we are talking about cost of financing for long-term. Okay, long-term financing. Okay, so again, we're going to discuss the types. However, in terms of the characteristics, yeah, I will go very brief with regards to the characteristics because we're going to discuss three different options which we've already learned before. If you recall, we have bond, we have preferred stocks, and we have common stocks. Okay, these three will be the options that we have when we talk about long-term financing. Okay, so whenever a company requires funding, for example, long-term basis, okay, these are the three options that they can choose from. Okay, either to issue a bond, issue preferred stocks, or even issue common stocks. Okay, some are considered as debts, for example, like bond. This is actually an element of debt, whereas common stocks, for example, is the element of equity. Okay, so these are the two considerations that you need to make, whether to use debt, hutang, or to use equity, okay, in the form of stocks. Okay, and all three we've discussed earlier in the bond and stock valuation. And remember, regarding the securities here, there's always two parties. Okay, there's always two parties with regards to these instruments. Meaning, there will be one party to issue the instruments, and the other party who will invest in the instruments. So in terms of the bond valuation, stock valuation before, that's from investors' point of view, those who invest in these particular instruments. For today, we are going to discuss from issuers' point of view, okay, which are the company. Okay, when company face shortages of funds, this is what kind of securities that they can use in order to raise fund. Okay, so as I said, capital is very important. Okay, whereby if we don't have enough capital, as a company, they might have facing problems with regards to productions, for example. So they need to have proper financing, meaning where can they get the capital from, right? And like I said earlier, there are always two parts, whether to raise the funds using the debt element or the equity. Okay, so again, if you recall in our balance sheets, and we have assets here, then we have liability and equity. Right, so the right hand sides are the structure or the capital structure of a particular business. Okay, so in order to acquire assets, they need to either to use liabilities or equity, to use debts or to use their own money. Okay, so this is the consideration that they need to make. Okay, whether to use debts, meaning to raise fund using debt. Again, remember debt example would be bond, or equity, both for preferred or even common stocks. Okay, so that's why we're going to discuss all three afterwards in terms of which would be the suitable options for the company. Right. This one, most of it we've discussed before. Okay, so this is the consideration I said in terms of which one would be preferred between debts and equity. So you have to give and take both, meaning both instruments ataupun both categories will have pros and cons between one to another. For example, first would be the management control. Okay, management control. If you prefer to use debt, for example, okay, debt meaning you issue bond. Okay, so in terms of management control, you will not have any problems because debt holders, okay, debt holders which are considered the bond holders, okay, do not participate, meaning they are not the owners of the company. So therefore, they will not, okay, they will not participate in any decision making of the company as compared to equity, for example. Okay, equity, if you issue common stocks, for example, you are actually allowing outsiders to become part of the owner of the company. So therefore, once they are the owners of the company, they can participate. Right? So here, debts, they will not control ataupun they will not interfere. But for equity, yes, okay, equity will participate. Therefore, they will interfere with your decision making. So meaning you now cannot decide on your own. You have to allow other people to give opinion as well. So that's the risk, or that's the thing that you need to remember if we issue equity, for example. Second, second is about the cost. Okay, cost of debt is cheaper as compared to equity. Okay, reason being because the the interest that you pay to the bondholders are tax deductible. Okay, remember dalam bond, we have what we call as bond, a coupon. So these coupon payments to the bondholders are tax deductible. So therefore, the cost of debt for bond is much cheaper as compared to equity. Right. Now, these are the three elements or the three instruments I said earlier. Okay, again, as I said, by now you're supposed to be exposed with bond already. We've discussed these features in the bond valuation before. So I'm going to discuss this very brief, okay, just to touch a bit, to recap, which are considered important. Okay. For example, as I discussed before, bond is a long-term promissory notes. Okay, the keyword is long-term, number one, whereby the duration of the bond can last between 5 to maybe 40 years. Okay, very long, and can be issued by the government or by corporations. Okay, corporations. Okay, the rest I will not touch because we've discussed this before in terms of the contract. Okay, just a recap. Remember the features of a bond. Number one, we're going to assume that the par value will always be 1,000 ringgit. Okay, 1,000 ringgit. So meaning if the company wants to raise 2 million ringgit, if we want to get 2 million ringgit from this transaction, they need to sell 2,000 pieces of bonds. Remember, bonds is just like a piece of paper, a certificate. So in order to get 2 million with 1,000 ringgit per paper, the value. So therefore, the company needs to sell 2,000 pieces of bonds in order to raise 2 million ringgit. Okay. And as I said, for bond, we have the coupon interest that the issuer needs to pay every year. Okay, without fail, every year. It can be annually or even semi-annually. And one of the elements of returns we've discussed before, okay, with regards to the investor, whereby we measure the YTM, the yield to maturity. So for today, okay, when we look from issuer's point of view, we're still going to use YTM, but with a little twist with the formula. Okay, because we are looking from issuer. Remember, there are two parties, the issuer and the investor. Okay, if we put bond here in the middle. Okay, so issuer is the seller of the bond. Okay, and when they sell the bond, investor will purchase it, and the money or the proceeds from this sales of bond will go to the issuer. Okay, issuer will receive the money, the bond, the certificate will be passed to the investor. Okay, the investor will get returns in the form of coupon. Issuer needs to pay the coupon. Okay, so one of the common measurement between the issuer and investor is the yield to maturity. Okay, again, from investors' point of view, this will be their returns, and from issuers' point of view, this would be their costs. Okay, because they have to pay this amount. Okay, but when we look from the cost point of view, obviously we're going to use some alterations to the formula. So later on, still we're going to use YTM, yield to maturity, but I will show you some twists ataupun some slight variations in order to calculate the actual costs when they issue bond. Okay, remember, for today, we are looking from the cost point of view, okay, cost of issuing, right? Okay, all of these are already mentioned before juga, okay, in terms of maturity, in terms of the rating agencies, who are the rating agencies, right? The provisions to call. Okay, but for today, you don't have to worry about call. If you remember last time in bond valuation, besides YTM, you also have on management YTC, kan? Okay, we don't have to worry about the call today. So we just focus on the returns part. Okay, this one also already discussed before in terms of the types of bonds, secured and unsecured. The only difference between the two categories would be the secured bond would be pledge, okay, with securities, meaning with collateral. So for unsecured, without collateral. Okay, without collateral. Okay, you can read on your own later on between the secured and unsecured. Okay, the ones that concern us today, like I said earlier, is the cost. Okay, how to calculate the cost of issuing bonds. Okay, so you're going to see there are two types, there are two ways how to calculate. Okay, I'm going to choose the easier one for you to use, which, like I said, we're going to use the YTM approach, yield to maturity approach. So unlike our bond valuation, we just calculate YTM, that's it. But from issuing point of view, okay, as I said earlier also, bonds coupon are tax deductible. Remember? This one, bear with me 1 second. Bonds coupon are tax deductible. That's why the cost of funds for that usually will be cheaper. Okay? And therefore, since we are measuring the issuing punya point of view, we are looking from after tax, because they are tax deductible just now. So therefore, the cost, we're going to look from bonds point of view, the after tax cost. Okay, so therefore, the formula for after tax, okay, where we use the terms KD here, cost of debt. K here is cost, D is debt, which actually refers to bond as well, is the small KD, or you can substitute this small KD with YTM as well. The yield to maturity that we're going to use later, okay, times 1 minus T, where T is actually the tax rate. Okay, T is the tax rate. So I recap, to find the after-tax cost of debt is actually yield to maturity multiply with 1 minus tax rates. Okay, this is actually the after-tax cost of debt. Okay, after-tax cost of debt. And again, if I can quickly write the formula of YTM, okay, it's the coupon plus last time we used par value minus market price divided by N. Then we divide everything, par value plus market price divided by 2. Okay, this was the formula for yield to maturity based on investors' point of view. Okay, investors. Here, when we want to calculate the yield to maturity for the issuing point of view ataupun the issuer's point of view, there will be some slight variation to this market price. Okay, because this market price will be based on what we call as proceeds. Okay, where the price we need to less or we need to minus the cost of issuing. Okay, remember when we want to issue bond to the market, the company needs to hire or needs to employ bankers. okay, ataupun brokers to sell the bond for them. Okay, and that activities, the exercise requires costs. They need to pay the brokers some issuing costs. Sometimes we call them issuing costs, IC. Sometimes we call them brokerage fee, BF. Okay, so this cost is payable to the bank. Okay, and therefore this net proceed kat sini here. MP ni sometimes we can use the terms P0. Okay, this is the only different as compared to before. Remember, from investor point of view, they don't care about cost of issuing because they are not the one who bear the cost. They just concerned with the market price during that time. Okay, during that time, what would be their price lah. Okay, but from issuer point of view, they need to take into consideration the issuing cost because they are the one who pay the cost to the issuer. To the banker. So therefore, the net proceed, we're going to use this. Okay, this very important to differentiate between the investor's point of view and the issuer's point of view. Okay, but the rest are the same. Okay, the rest are the same. Okay, there are two parts meaning. So first, if you want to calculate YTM, we need to take into consideration the net proceeds. Second, once we have this YTM, we need to take into consideration the after-tax cost. So meaning after we have this YTM, we have to multiply the YTM with 1 minus T in order to get the after-tax cost. So here, there are going to be two steps in order to find the cost of debt, right? So as I said, we just focus on this one, the YTM method. So you don't have to worry about discounted cash flow techniques. So actually, you've done this before when we've done the bond valuation, okay? But it's quite complicated a bit to use this method. So I just focus on the YTM, okay? So let's use this example. Okay, this company plans to issue 1 million ringgit, okay, worth of bond with a face value of 1,000 ringgit per paper, and the annual coupon is 12%. Okay, so this is the C, the coupon for 10 years. So this is the N. And due to high interest rate, can be sold for 950. So this is the market price. Okay, market price. And this is the issuance cost. Okay, remember this issuance cost will not appear for investors because they don't care about issuance cost because they are not the one who issue the bond. They are just the buyer of the bond. Okay, but for issuer, okay, they need to bear this cost. Okay, so this will be our issuing cost. Right? For the question itu je kan. So we have the value, even though this will not be used in our calculations, but the rest is here. Okay, now first step, if you want to calculate the cost of debt, first step is to calculate the YTM. Okay, using again this formula, I'm gonna write again here just for the sake of your notes here. So we have the coupon plus par value, okay, minus. So I'm gonna write in detail the formula, which is market price minus issuing cost, if any, by N. Okay, market price minus issuing cost. This is actually P0. We can put it as a P0 lah. Market price minus issuing cost. Okay, or the proceeds just now. And we're going to divide everything by par value plus the one in the bracket. Price minus issuing cost. By 2. Okay, so the only difference in this formula will be in this bracket. Remember last time, from investors' point of view, we just use the market price. Okay, but here we need to minus with the issuing cost. That's it. So therefore, if you want to translate all of this information inside our formula, so the coupon is 12%. So 12%, remember we have to multiply with 1,000 ringgit to get the coupon payment. So 12% times 1,000 is 120 ringgit. Plus the par value is always 1,000. And we need to minus the cost, or the selling price is 950 and the issuing cost is 5%. Okay, so 5%. Okay, this is one thing. If the question doesn't specify the issuing cost 5% of what, we're going to assume this 5% is based on par. Okay, based on par value, which is 1,000 ringgit lah. Okay, but some question, they might state that the issuing cost of 5% from the selling price, for example. Then you're going to use 5% out of the selling price. Okay, but if they don't specify, we're going to assume that this 5% is based on the par value. Okay, so just be careful about that one. Okay, unless they specify, you use par. Okay, remember, if they don't specify to use any reference, whether to use market or par value, we're going to use par. But if they specify, okay, 5% of market price, then we use market price lah. Okay, so 5% of 1,000 is 50 ringgit. Okay, 50 ringgit. So therefore, 950 times 50 is actually 900 ringgit. The one in the bracket is actually 900 ringgit. The proceeds. Divide by n, and n is 10 years. And we divide everything by 1,000. Okay, the one in the bracket is 900, so I'm going to put plus 900 divided by 2. Okay, let me get calculator. So 1,000 minus 900 divided by 10 plus 120 divided by 100 by 2. So here we have 13.68%. Okay, 13.68%. Okay, but again, this is not the end of your answer. This is just the cost to issue the bond, but without taking into consideration the after-tax effect. Okay, so actually the question asks us to calculate the net proceed. As you recall, the net proceed is actually 950 minus 50 ringgit. The one in the bracket tadi, So you have 900 ringgit. So this is our net proceed, and that's why we use this 900 here. Okay, now once we have this YTM, secondly, actually, we need to find the KD, cost of debt. And remember, the formula for cost of debt, ataupun the after-tax cost of debt is YTM times 1 minus T. Okay, so I recap, you need to use this formula first. Next, you're going to use this one. So the YTM is 13.68%. This one, 13.68%. And our tax rate is 40%. So 1 minus 40%. So 30 times 0.6. So we have here 8.21%. Okay, 8.1%. So this would be our final answer, the after-tax cost of debt. Right? So if you stop until here, this is not considered your final answer. This is not correct anyway. Okay, remember, because when we issue bond, we always take the after-tax because the coupon that we pay to the bondholders are tax deductible. So that's why we, in order to get the actual cost, we need to deduct the tax rates. Okay, we have to minus the tax rate from our costs, and this will be our final cost of debt. Okay, ataupun KD. Right? Any question so far? Okay. Okay. Like this line. Now, let's move on to the second options. If they want to raise fund, okay, is by using preferred stocks. Again, if you remember last time, we mentioned that preferred stock can associate with hybrid instrument. Okay, so why it's hybrid? Because they share the features from bond and also common stocks afterwards. Okay, so in terms of sequence, in terms of treatment of receiving claims, for example, right? Remember this sequence, the ranking always starts with bond, followed by preferred stockholders. And lastly, number 3 would be the common stockholders. Okay, so preferred stockholders will always be in the middle. So in terms of risk, it's obviously less risk as compared to common stock because they're received in the middle, but slightly more risky as compared to the bonds because the bond is the first one to receive. Okay. Right. Again, some recap on the characteristics. For bond just now, the par value is 1,000. For preferred, the par value is 100 ringgit. Okay, 100 ringgit. We don't have coupon, but we have dividend. Okay, but similarity between preferred and bond is the fixed element. Okay, bond has fixed coupon, preferred stock have fixed dividend. Okay, meaning the rates will not change. Okay, and again, similar like bond, it will stated in percentage. Okay, percentage directly from the par value. Remember just now from the bond question, the bond coupon was 12%. We multiply with the par value 1,000. Okay, similar like here, preferred stocks, whatever percentage, we're gonna multiply with the par value of 100 ringgit. Okay, so the rest, I think I already mentioned tadi. So there are two parts here. Okay, most of the time we're going to use this part. Okay, to find the cost of preferred stocks. Remember earlier number 1 tadi we have KD, the after tax KD. Now number 2 we are looking from cost of preferred stock KPS. And the formula, okay, the formula is like this: dividend per share or annual dividend divide by. Again, we're going to have some sort like a proceed here. And this proceeds is actually the price minus rotation cost. Okay, price minus rotation cost. It's just like our bond just now, market price minus rotation, right? So we're gonna have the same thing here. And if the question asks to find the price, if the formula is dividend per share divided by cost. So technically it's the opposite. You just switch the positions to find the price. Okay, but most of the time, like I said, just gonna focus on the cost of preferred stocks. So example like this. Okay, PTA2 plans to issue 1 million ringgit worth of preferred stocks. Okay, and the par value is 100 ringgit. And this company intend to pay 10% dividend. Right, and the market price of the issuance will be 98 ringgit with a 5% flotation cost. Again, this example, they use 5% of flotation cost without referring this 5% to which value. So again, we're going to assume this 5% on par, okay, on par value. Okay, be careful on the questions, but sometimes the question can say like this: 5% flotation cost from the market price. Then 5% will be based on this market price. Okay, but in this case, since there's no mention about anything, so we're going to assume this 5% based on the par value, 100 ringgit. Okay, see the word calculate the after-tax cost for the preferred stocks. Okay, just to let you know, for preferred and even common stocks, regardless whether they state after tax or not, the cost of preferred stocks, like this, the formula, we're going to use this alone, meaning we don't have like KD just now, we have KD 1 minus T, like this part. Okay, like KD, we have YTM minus, multiply with 1 minus T. But for preferred and common, we don't have to do this because remember, for equity, it's not tax deductible. Okay, therefore, even though they might use the terms after tax here, we just use this formula to find the cost because, like I said, costs of the dividend that they pay to the stockholders are not tax deductible. Okay, not tax deductible. So therefore, to find the KPS, so the dividend is 10%. So 10% of 100 is 10 ringgit. The price is 98 ringgit. And the flotation cost is 5% of 100 is 5 ringgit. So it's 10.75%. That's it. Very simple. The preferred stock is actually the easiest one to calculate and the fastest one to calculate. So we just need to have 3 information. First is the dividend, okay, current dividend. divide by 98 ringgit, which is the market price, minus the flotation cost. Okay, and this is the only thing that might hurt you in terms of calculation. First, determine the market price. Okay, don't use 100 ringgit. Okay, do not use 100 ringgit here. It must be based on market price. Secondly, it's based on the flotation. Okay, just like this question, it's very straightforward because it's 5% of 100. Just be careful if they say 5% of the par. So kalau 5% of the par, it's not 5 ringgit here. It will be, for example, times 98. It will be, sorry. It will be 4 ringgit 90 cents. Walaupun difference is 10 cents, yeah, but because you use different figure, your answer will not be accepted. Okay, so just read the question carefully. Okay, if the 5% is based on market price. Okay, if we use, atau if we can do some exercise later, I'll show you if there's such example. Okay, so for KPS, very straightforward. We have 10.75%. Okay, 10.75%. If the question asks to find the price, yeah, you can use this formula to find the price. Okay, the last one. Okay, the cost for common stock. Remember, the common stocks are the owners of the company, the real owners of the company. Okay, so therefore, if they are the owners of the company, they have to take the highest risk. They have to bear the most risk as compared to the rest, the bondholders and even the preferred stockholders. So as I said, it represents the ownership of the firm. So once you hold the positions of owners, obviously you are entitled for some privileges. Okay, you are the real owners of the company and bear more risk, as I said. So some characteristics, we don't have a standard par value. So meaning every company might have a different par value in terms of the common stocks. Okay, so this par value you can see from the balance sheets of the company. So you need to look in the balance sheet in the common stocks value. There you can find the par value of the stocks. Okay, unlike bond dengan preferred, whereby the par value is fixed 1,000 and 100 ringgit respectively. Okay, but not for common stocks. We don't have a standard par value. Right, retained earning again. This is from your balance sheet. You can see this retained earning. This is a cumulative amount that the company reinvests whatever profit ataupun unused profit and the payment of profit ataupun the non-payment of profit to the investors. Okay, macam ni lah. If you recall, the profits of the company, they will pay dividend to shareholders. Okay, but the leftovers, meaning the unused money from the dividend payment, they will park it under retained earning. So this retained earning will be cumulative from one year to another. So if the company performing well, they earn a lot of profits, then they have excess funds a lot, they will have higher retained earning every year. Okay, so just imagine retained earning just like their reserve. Okay, so they might use retained earning in the future for whatever reason, in terms of development of the company, in terms of payment to shareholders even later. Okay, and also paid-in capital. So paid-in capital is the initial capital that they invested in the company, right? When they newly developed the company. Okay, so I don't want to talk about it. So for the valuation, we have a few measurements. Okay, we're not going to use zero growth. The one that we're going to focus on is actually based on this one, the constant growth stock model, the golden growth model. All right. Remember in the stock valuation, we have four different models. We have constant amount of dividend, inconstant amount of dividend, we have constant growth, and we have inconstant growth. So this is actually based on the third model. Okay, the constant growth model. So what does it mean? We're going to have a growth rate. Okay, we're going to assume that the company's dividend will increase every year at a very specific growth rate. And this growth rate will remain constant forever. Okay, so therefore the formula is for cost of common stocks. So again, number 1, we have 2, we have KPS. Now number 3, we have KCS. Again, if you recap, for the investor's point of view, we have VB, kita ada value of bond, we have VPS, value of preferred stocks, and lastly, we have P0, okay, the intrinsic value of the common stocks. This is for investors. But for issuers, we are focusing on the cost. So we use all the symbol K. Okay, KD, cost of debt. Again, if you can recall the cost to growth model, remember the formula is revolved around D1. Okay, dividends for the next year. Ataupun an expected dividend. Okay, the next dividend. Right, so to okay, so that's why the formula here is D0 multiply 1 plus G, which is actually to find the D1. Okay, the next year's dividend. And this time around, we're going to divide by price minus flotation cost. This is the market price. And again, the flotation cost. And once we've done the one in the bracket, we're going to add with the solve this the one in the bracket. We're going to add with the growth rate. Okay, so let's look at the question. Okay, we're just going to skip this part. I don't think we're going to use this KRE, cost of return. Remember the cost of debt, by the way, cost of debt, cost of preferred stock, and cost of common stock. This is actually cost if they want to get it, ataupun they want to raise the funds from outside of the company. Meaning all of these are raised from external. We're going to receive funds from external parties. However, the company can decide to use their own money. Okay, where is the source? Remember, I said tadi we have retaining as part of our reserve kan. If the company has a lot of funds kat dalam ni, okay, they can use their own money. So therefore, in order to calculate the cost using the retaining, the formula would be something like this. Okay, we need to know the cost of common stocks multiply with 1 minus tax rate. Okay, and this is personal rate multiply with 1 minus brokerage fee. Okay, but again, for this semester, we don't worry about this part. Okay, we just focus on these three je. KD, KPS, and KCS. Okay, so let's try this example. Okay, and again, just ignore this part. The company is planning to issue a new common stocks issuance with a flotation cost of 5%. Okay, so this is our flotation cost. And the dividend, 20 cents with 10% growth rate. Okay, 10% growth rate. Market price is 5 ringgit. So this is the market price. Okay, so we don't care about this personal tax rate because we don't calculate the KRE. And the brokerage fee of brokerage fee for this also will not be taken into consideration because we don't calculate the cost of retained earning. Okay, so there are some error kat sini sebenarnya. If you look at the question, dia beritahu they expects to pay dividend of 20 cents. Remember the terms that we're going to use when we want to identify whether it's D0 or D1. Okay, so D0 refers to paid dividend, whereas D1 is expected dividend. So this question is actually use the terms expect. Okay, so this 20 cent is actually referring to D1 already. So therefore, in order to find KCS, okay, formula dia, if you recall tadi, is actually D1. Price minus flotation cost. Okay, and plus D. And D1 is actually based on D0 times 1 plus D if the question gives you D0 like this. But since the question already give us expected dividends, okay, so this is actually 20 cent is our D1. And the price is 5 ringgit. And the flotation cost 5%. So 5% of what? 5% of 5 ringgit lah, because we don't have our value. So 5% of 5 ringgit is 25 cents. Okay, I recap. For flotation costs, okay, for last time, we use this against the par value. Okay, but for common stocks, we don't have par value. Right, so therefore, this 5% we always use based on the market price. Okay, the market price is 5 ringgit. So 5 ringgit times 5%, we have 25 cents. Kat sini. And I add growth rate. So the growth rate is 10%. So cents divided by 5. It's 14.21%. Okay, 14.21%. So this will be our cost of common stocks. Okay, again, similar like preferred, we don't have after tax. This will be the cost. All right, as you can see here, most of the time, cost of common stock will be the highest. Okay, will be the highest, meaning it's the most expensive, and bond would be the cheapest most of the time. But if we look from your questions to your final, for example, don't assume like that. You have to calculate all, and you may have to make comparison. Okay, you may have to make comparison, right? And to choose. Okay, so don't use this one. It's slightly wrong. So we don't have to multiply with the growth rate actually, because this is your D1 already. Okay, I'm gonna change this later. Anyway, don't worry about that one. Right, before we move on to the last part here, the WACC, the WACC. Okay, so far, as I said, we have 3 options. Number 1, cost of debt. Number 2, cost of preferred. And number 3, cost of common stocks. Right, so usually the question will give you this scenario. You have 3 options with different rates. Okay, please calculate and choose which is considered the best option. So you're going to calculate the KD, the after-tax one, the KPS, and the KCS. And to choose, usually we're going to choose which one is the cheapest. Okay, which one will be the cheapest, and that will be our choice. Okay, consider the best option. Okay, the cheapest option. That's one scenario. Okay, but sometimes, okay, with regards to long-term financing, because this is a longer terms kind of option, ataupun longer terms financing. Some companies very concerned with their capital structure. Okay, what does it mean by capital structure? Remember, I showed you these assets and debt and equity side, right? Remember, as a company, they are very particular with regards to what we call as capital structure. How they structure their compositions of capital, the debt factor and the equity factors. So let's say currently the company has 100 million worth of assets. Okay, 100 million worth of assets. And they have this composition. Out of this 100 million, 30% is from debt. Okay, and meaning equity will be 70%. So meaning if it's in ringgit, it will be 30 million and 70 million here. Right? Right. If, let's say, after we have this current capital structure, the company needs money. Okay, they needs funding, and they have these 3 options. Okay, let's say based on our calculation earlier, the best is debts. Okay, because the cheapest is usually debt, right? So they need 100 million, ataupun let's say they need 20 million. Okay, they need 20 million and they issue debts. So what happened? this asset will increase by 20 million because they need 20 million additional. Okay, so if they use 20 million all here, in that meaning their value of debt will increase to 50. So meaning this is original and this is new. So based on the new requirement tadi, they need 20 million more. So these assets will become 120 million because they would need to inject 20 million. And the source of this 20 million comes from debts. So what happened? It will be 50 million debts. The equity will be 70 million because they use all debt. 70 million. So will it be 30-70 anymore? The composition. So 50 over 120. So now it's become 41% or 42% debt. So meaning here is about 58%. So can you see the difference of the structure or not? From 30% debt to 42% debt. So meaning the company now rely more on debts. So some company don't want to change their capital structure. They don't want to change their style of managing their business. Right? So therefore, instead of the 20 million required, all using debts, they're going to use everything that they have here. Going to use all using the original structure. So meaning if I want 20 million, so 30% I will use debt. The 70% I'm going to use my equity. Following the original structure. And because of that, okay, because of this nature, this is why we have weighted average cost of capital. Meaning by using this, we're going to use all options, but according to the original composition. Okay, composition of the individual costs based on the weights. Okay, remember weight, this is an example of weight, 30-70. And we're going to multiply with the cost. Okay, remember we've calculated our KD, KPS, and KCS earlier. That will be our cost. So simply multiply the cost with the respective weights of the structure. Okay, so the formula would be weighted average cost of capital ataupun WACC equals to the sum of, okay, the sum of the percent of capital structure. Okay, simply means the weights. We want to find the weights, multiply with the cost of capital. So meaning the KD, the KPS, and the KCS respectively. Yeah. So each one will have their own weights. So respectively multiply, and then we total up because you need to sum everything in order to get the WACC. So meaning simply means weight 1 plus weight 2 times KPS plus weight 3. Okay, multiply with the KCS. Then you get the sum. This is our WACC. Okay, simple as that. So we have all costs. Okay, we're going to use the original, walaupun different question tadi. We're going to use, ataupun we're going to assume the 3 rates. Tadi, we have 8.21, the first one tadi. Bear with me, 75. 821, 10.75, 14.21, 14.21. Okay, these three we're going to use in our explanation of WACC. Okay, I'm going to change ini juga lah, 14.21. So if the firm has agreed that its optimal capital structure consists of 30% debt, okay, so 30% preferred and 40% equity. Okay, so note that the composition 30, 30, 40, when you combine all, equivalent to 100%. It must be 100%. And find the WACC based on these three compositions. So we have 8.3, 8.35. Give me a second. 8.1, so we're going to use 8.1. 8.35 is based on, this is based on the discounted method. So both 0.21, so I'm going to change this all 0.21 at the back. So what we need to do, simply take the weights for the respective instruments, multiply with the respective costs. So for example, the debt is 0.3, 30% times 8.21. Then we add with preferred is 30% also times 10.75. And lastly, equity 40% multiply with 14.21%. So it would be okay, so it's 11.37%. 11.37%. And this is the weighted average cost of capital. So this is actually the average, okay? But it's not a simple average whereby you take 8.21 plus 10.75 plus 40.21, then divide by 3. No, that's based on simple average. But here, we are using the what we call the weighted average. We have the weights, 30, 30, 40% here. So this is more of a based on composition of the capital structure. Okay, one more thing. For this question, the weighted average here, ataupun the weights, is already given like so, 30%, 30%, 40%. Some questions might not give you this direct information. So meaning, it might give you in the form of values. Okay, in terms of value. Again, for the sake of easier calculation, I'm going to give you simple example. Instead of giving you this percentage, they're going to give you information in terms of the bond value. This is based on current structure. They will give you bond values, preferred stocks, and common stocks. Let's say they give you bond worth 30 million ringgit, preferred stocks 30 million ringgit, and common stocks 40 million ringgit. Okay, they give you in the form of values. So you need to convert these values into percentage. So what you need to do, you need to total up what will be the total values currently. So total here is 100 million. And then you take respective values, divide by the total value. So meaning for bond is 30 million, divide by 100 million, it will be 30%, 30%, and 40% here. Okay, so this is alternative way. Okay, if the question give you in terms of value. Okay, find the total and then divide the respective values with the total value to get it in percentage. Okay, it's possible that way, right? So just be careful lah if the question doesn't provide you with the weights directly. Okay, is there any question? Okay, because it's actually the end of the topic already. Okay, for the cost of capital, you need to remember we have three options: the bond, preferred stocks, and common stocks. All three have different approach in terms of calculation of the cost. The bond, you need to beware about the after-tax costs. Okay, the preferred is the easiest one to calculate, and the common stocks, you need to know the growth rates. Okay, and be careful about the dividend. Right, so let's take 5. Okay, let's take 5 and let's try one question. Okay, related to the cost of capital topic, so that maybe it will give you better understanding of this topic. Right, but let's take 5 first. Okay, so I'm gonna leave you for a while with this question. Can you try this? Salah ni. Need all the marks ni. Okay, so I give you around 15 minutes to try this question. Okay. I'm going to discuss after that lah. So at 3:30 we're going to discuss this. So please try this first. Okay. So if you try the question number 3. So for this question, the company requires 2 million ringgit. By the way, even the question provide us with this value. Actually, we're not going to use the value in any of our calculation. Okay, not one time but we use in our calculation. So we just focus the ones in the bullet here. So we have 3 bullets. So let's go one by one. So I'm going to put some space in between so I can calculate. Okay. So first, okay, the first option is to issue 14%. Okay, 14% coupon, which is bond, yeah, in this case, long-term debt at 5% discount. This would be market price. This is the coupon. Mature in 15 years, so this is the end. This is the issuing cost, rotation cost, 8% off market price, off market price, not the par value, 8% off market price. And we have the tax rate T, 35%. Okay, so first thing, we need to know the market price because here the market price is not given in ringgit. Instead, they give 5% discount. So what does it mean? The value of the market price is 5% discount from the par value. 5% discount. So meaning it's 1,000 ringgit. Okay. 5% discount meaning multiply with 95%. Okay, 1 minus 5% is 95%. So be 950 ringgit. So this is the market price. Okay, this will be the market price. And this flotation cost 8%, yeah. So 8% of market price, meaning 8% of 950. Okay, if you calculate 8% of 1,000, it will be wrong, basically. So here it's 8% of 950. Right? So 950 times 8%, it will be 76 ringgit. Okay, so this is our issuing cost. Okay? 8% of 950, which is 76 ringgit. Now we have all the information. So first, we're going to calculate the YTM. One is 14%. So for 14% times 1,000 is 140 ringgit. Plus the par value is 1,000 minus its market price minus rotation cost. Divided by N, and then our N is 15 years. Okay, and we divide everything by 1,000 plus 950 minus 76. So 950 minus 76 is actually 874. So the one in the bracket is actually 874. So 1,000 minus 874 divided by 15 plus 140 by so here we have 15.84%. 15.84%. So this is our yield to maturity. Okay, based on this question, first bullet. And secondly, to calculate the cost of debt. KD, it's 15.84% times 1 minus tax. Our tax rate is 35%. So it's 10.29%. Okay, so this is our final answer. Okay, the cost of debt, 10.29%. Okay, so that's our first option based on coupon ataupun based on debt, based on bond. Now let's move on to the second bullet, okay, whereby they issue 9% preferred. Again, they use the term discount. Remember, the question can use the terms discount and premium. Okay, discount and premium. If premium means higher than par, it's discount lower than par. Okay, par value respectively lah. If it's for bond, the par value is 1,000, or if it's preferred, the par value is 100 ringgit. Okay, so they can use the percentage 5% premium or 5% discounts, 10% premium, 10% discount, whatever. So if it's premium, you increase by that percentage, and if it's discount, you minus that percentage, okay, to get the market price. So in this case, it's 15% discount also. Here earlier tadi we use 5% discount. Okay, again, some question might use the terms premium. So if it's premium, you increase by that percentage. Okay, and again, the flotation cost, in this case, the 5% flotation cost is based on par. So meaning it's 100 ringgit par times 5%, which is 5 ringgit. Okay, so the issuing cost is 5 ringgit. Very straightforward. The market price would be 100 ringgit minus the 15% discount. Okay, so meaning 1 minus 15% lah, basically. So 5%. 5 ringgit lah. Okay, 5 ringgit. So how to calculate the cost of preferred stocks? Okay, so the formula is the dividend. So the dividend is 9%. So 9% times 100 is 9 ringgit. Okay. Remember, the dividend is 100 ringgit times 9%, which is 9 ringgit. So that's what we have here, dividend 9 ringgit. The market price is 85 ringgit. The flotation cost is 5 ringgit. So 9 divided by 80, it's 11.25%. 11.25%. So this is our second option. Second option, 11.25%. And the last option is common stocks. Okay, issue common stock at 23 ringgit. So this is our market price. The recent dividend paid was 80 cents. So they use the word recent. So this is our D0, 80 cents. And the growth rate is 8%. So this is our G. Issuing cost is 120. Direct. So what would be the KCS? Okay, so remember the formula for KCS is D1. Okay, D1. So it would be D0, which is 80 cents, times 1 plus G. So the G rate is 8%, so 1.08. Divided by the market price is 23 ringgit. And our flotation cost is 1 ringgit 20 cents. Okay, so the whole thing here need to add with G, which is 8%. So here we have 11.96%. This will be our cost of common stocks. So 80 cents times 1 plus 0.8 to have our expected dividend. And then divide by market price minus the flotation cost. And we add with the growth rate, which is 8%. So here we have the final answer of 11.96%. So almost 12% for our common stocks. So the first question asks us to choose the best option and justify. So out of 3, okay, remember for bond, we're not going to use this. You always refer to the after-tax cost of debt. Okay? Do not use 15.84, or else you're going to choose preferred in this case. But the lowest is actually bond at 10.29%. So select the best option. So you're going to say the best option. Best option is bond. Best offers lowest rates. So that's our justification, because bond offers the lowest rates. Okay, but for the second question, if the company wants to maintain its, its current capital structure, which consists of 25% bond, 40% preferred, and 35% common stocks, what will be the WACC or WACC? So to find WACC, okay, you have all the respective values of cost. Yeah. So this is where you need to get your cost correct, or else your WACC will be wrong somewhere. Okay. So here we have the bond is 25%. It's 10.29. $10.29 plus the second is 40% preferred. Preferred was 11.25%. 11.25%. And the last one, 35% weight at 11.96%. Okay, remember why we have this WACC again? Because the company wants to maintain its capital structure. So meaning, if the company needs 2 million ringgit, okay, 2 million ringgit, so 25% they're going to use bond, 40% they're going to use preferred, and 35% they're going to use common stock. So if you want to put in ringgit, so it would be something like this, 2 million. So about 500,000. 500,000. They use bond. Mana they're gonna issue 500,000 worth of bond. So 2 million. So 800,000. 800,000. They're gonna use preferred stocks. So the balance of 700,000, they're gonna use common stocks. And if they issue the 2 million according to this composition, whatever, meaning the 25, 40, 35 will remain the same. Okay. As I said lah, kalau they use bond in totality, okay, imagine lah, the composition will be different. It's not 25, 40, 35 anymore. Okay. So in this case, berapa? So 5 times 10.29 4 times 11.25 35 times 11.6. So here it's 11.26%. So this would be the average cost. So meaning when they take 500K with bond, 800,000 with preferred stocks, and 700,000 using the common stocks, the average cost for them would be 11.26%. Okay, so it would be somewhere in the middle. So obviously it would be expensive if they take as compared to taking bond alone. But in order to maintain its current capital structure, the average cost for them is about 11.26%. 11.26%, correct. Okay, so this is the way to find the WACC or the WACC if the person asks you to do so. And remember, question for this time around, still use a direct weightage. Okay, they give you the weightage directly to you, right? Or else you need to calculate yourself using the current structure. Okay. So kalau dia tak bagi weight like this, they're going to give you the current structure of the company. Okay, with values lah. How much is the bond, the preferred, and also the common stocks respectively. And then you need to find the total, as I mentioned earlier, and use respective values divided by the total values in order to find the weights for each securities. Okay, the bond, the preferred, and also the common stocks. Okay, I think that's about it. One of the example. Okay, if you have time, you can try other questions. Okay, cuma yang lain ni tak ada question about WACC lah, but you can try to calculate the cost of respective instruments, cost of bonds, cost of preferred, and then common stocks, the different scenario. Okay, so I think that's about it for today. So again, thank you very much. And I will give out the ongoing assessment by stages. So keep checking your, I don't know, the system, what's the system called? I'm going to release it via the student examination punya section. So you can check your ongoing assessment from there lah. Right? So I will let you know later in terms of the ongoing assessment. All right. So again, thank you very much. And inshallah, I'll see you guys later.